Hello, everyone. This is Chief Trading Strategist Blane Markham coming to you with my weekly market update, breaking down for you what I'm seeing here, what our team is tracking closely in the markets, and what I think you should probably be paying attention to as well. So let's go ahead and hop right in. So this right here, of course, is a chart of the S&P 500. And, despite, of course, some of the headlines over the past weekends, that have really kind of rocked and unsettled markets globally, things are still continuing to hold up pretty well here in the U.S. Obviously, we've seen a lot more volatility in indexes and stock markets overseas, in markets that might be a little bit more susceptible to energy shocks. But at least thus far, and fortunately here in the U.S. indexes are continuing to hold up quite strongly, as I had mentioned. So far this week, we did get one nasty day of selling. That was on Tuesday, when, of course, the market opened and sold off substantially. Shortly after the open, we did stage a very strong late day comeback, which was very encouraging. You can see that here in this bar shown right here. So, some very encouraging late day action on Tuesday. And of course, we actually continued to get some confirmation off that move in Wednesday's session as well. So seemingly, the market's trying to read the tea leaves of what is coming out of the Middle East, with the current ongoing conflict in Iran. And, it seems that, possibly we could be hoping for a quicker end to this conflict. Certainly would be a very good outcome for the market. So it seems, at least at this point, the market is not too overly concerned with what has happened thus far. But just looking at the technical picture here, it's a bit of a mixed picture when you just are looking at the charts here. So let me tell you what I'm seeing. So, of course, we still are overall in a longer-term uptrend here for the S&P 500. That's clear. That's confirmed as we're trading well above our 200-day moving average down here. That's our green line. This has been the case since last year, since we were coming out of those April lows, and we finally crossed above it in May of last year. However, there's a couple things that are, warranting a little bit of caution here at the index level. So the first one is one I've talked about for several weeks here. It's that, we're starting to see the ceiling on this market seemingly start to drop down. We previously in January and early parts of February were running into resistance on the upside, roughly around 7,000. But now it seems that ceiling of resistance has actually fallen down to roughly 69,000 and roughly right around where our 50-day moving average is. You can see several weeks ago, about 3 weeks ago, we actually traded down below our 50-day moving average once again, and ever since we traded down below this level, we've really struggled to, regain a footing and, hold firmly back up above that 50-day moving average. So it seems that that is now the clear level of resistance above this market is right here, right around 6,900. It's where the 50-day moving average is. So, in the intermediate term, we're obviously still locked into this range. It's compressed down between 6,900 and, call it 6,800 on the lower end. But, we're starting to see, that ceiling of resistance start to drop down. So certainly a level the market's continuing to struggle with there. However, one encouraging thing too, just looking at the daily price action there, is that the support level under the market, call it right around 6,800 on the lower end of the range, this has continued to hold even in the really brutal selling. Of course, we did crack through 6,800 intraday on Tuesday, during the trough of that really ugly selling that we experienced. We did rally back towards the end of the day, as I mentioned, and we were able to regain that level, and we actually closed above 6,800, of course, confirmed that move and closed well above 6,800 in Wednesday's trading. So seeing that we have not meaningfully closed below the 6,800 level and continue to confirm to the downside, that is one encouraging note there. And then the final thing I actually want to draw your attention to is in our lower study down here. And this just, again, speaks to the mixed picture that we're seeing here just at the S&P 500 index level. This is a MACD chart. And what I want to point out here is that, several weeks ago, I pointed out that our MACD actually dropped below the zero line here. So typically when you have the MACD trading above the zero line, that's bullish, that there's overall positive momentum behind a stock or index. But of course, the inverse is also true. So when it falls below zero, that is indicating negative momentum. Well, you can see that's what's happened here for the past several weeks. And we really have not regained this. For the past 3 weeks, we've remained below the zero line here with the MACD and continue to struggle to pop back above it. So that's really indicating that at the index level, we are struggling to have the index finally break out meaningfully one way or the other. And, it seems, just following the price action, it seems that the index is in a bit of a drift lower. If you just look at the price action, you can see it has just a bit of a slope to the downside here. You can see with a mild series of lower lows and lower highs. You can see our middle Keltner channel here is just mildly also sloping downward too. So overall, still largely range bound here for the S&P 500, but it seems like momentum is certainly beginning to stall out, and we are starting to test some lower lows, and possibly even could be setting up for a test of the 200-day moving average here in the weeks to come. But with that said, I did want to highlight one really interesting chart because certainly you see these geopolitical flare-ups like we experienced over the weekend, and is still ongoing as well too with the war in Iran. Typically, historically speaking, investors, when they see events like this occur, they typically are going to see a flight to safety, a flee to the safe haven trades. While we did experience a big rally in the dollar, you did not see some of the other typical safe havens get purchased. You did not see gold experience a huge rally on the back of that event. You also did not see investors pouring into treasuries and just buying up U.S. treasuries as a safe haven defensive bet. You actually saw the inverse. You actually saw gold sell off. And here we have a chart of the 10-year U.S. Treasury. And you can see ever since the first strikes happened in Iran over the past weekend, you can actually see yields did the inverse of what people would think. They actually spiked higher because of some of the inflation fears, potentially coming down the pike because of increased energy prices. So a bit of an interesting reaction from the market here. It seems that investors still have confidence in equities, given that you did not experience the large flight to quality into U.S. Treasuries that many would have anticipated. So while the spikes in energy that we have experienced thus far, and also rising Treasury yields too, have changed the bullish case for some sectors of the stock market, it certainly has not changed it for the entire equity market. And it's also created some interesting opportunities, just like this next one I'm going to share here with you. And this right here actually is a ratio chart, and I'll explain what this is looking at. So it's looking at an ETF. The ticker is CRAK. This is an oil refiners ETF, and the ratio chart is comparing it to the performance of the S&P 500 index. So this is one of those really interesting opportunities that, already had a lot of relative strength behind it. It had some really great price action, but of course the recent events have continued to turbocharge this trade. And so, of course, since this is a ratio chart, as you're seeing this line slope up here, that is indicating that our oil refiners ETF has continued to outperform relative to the S&P 500. So as you see this upward slope here, series of higher highs and higher lows, some moderate outperformance there from the refiners ETF. But of course, here over the past couple of months, really year to date, you can see substantial outperformance and relative strength here from the oil refiners ETF. So this is an area we're continuing to watch for new opportunities that are continuing to develop. We're not looking to chase some of the energy setups that, are really highly correlated with just the price of oil, because we fully expect there to be some continued volatility both to the upside and downside with just the price of oil. But with these refiners, this is a very different ballgame. They are not as correlated with just the underlying price of energy, more so with the actual products that they're making and refining. So you're continuing to see some really good performance here, some really interesting setups here with the major refiners. If you look up a chart of Valero or Phillips 66 or MPC, all of these charts are continuing to break out and have really, really strong setups, presenting some really interesting opportunities. So we're watching those very closely. But that's not the only place we're continuing to still see some great opportunity in the market. One of those opportunities we're still watching here and actually have sent out some alerts to our members for is for this one right here. This is one that we spotted several weeks ago, actually towards the beginning of February. This is for Target, ticker is TGT. And coming out of these November lows right here, you can see the stock was putting together some very strong performance, a nice series of higher highs and higher lows, starting to clear prior month's resistance. And you can see the trend line started to align bullishly midway through December, leading to a technical buy signal here for Target. And so this stock popped onto our radar several months ago as this breakout was unfolding. And on several different occasions, we've sent out trade alerts to the members of our ETA trade alert service. And the most recent one that we sent out was actually on this trading day right here, again, dating back to early February. We saw the stock rebounding off of this pullback from late January right here, is continuing the uptrend higher, making a nice new series of higher highs and higher lows. So we sent out that trade alert to our members to go ahead and consider going long Target by purchasing call options. And as you can see, the trade alert has worked out quite well as Target continued to leap to new higher highs, including numerous new 52-week highs. And if you just look at this week's price action, Target actually reported earnings, and their report was actually received very well by the market. You can see the huge gap up that the stock experienced coming off the middle counter channel there, gapped higher, continued to trade higher throughout the day, and also, traded up and hit a new 52-week high in today's trading as well. So this trade alert has continued to perform very, very well. It's a trend that we still are sticking with. We like quite a bit, and we'll be watching closely for additional trade opportunities. But that trade alert that we did send out to our members that's currently still active for our ETA trade alert members, that Target call option alert is currently sitting on an open trade profit opportunity of 84.9% as of the market close on Wednesday. So we've been very thrilled with how this trade alert has worked out. Now, I certainly hope that you are able to follow along with that trade alert and benefit from this great upside that's been offered by this positive price action from Target shares. Now, if you're not yet a member of our ETA Trade Alert service, that's totally okay. Just go ahead and reach out to Michael and his team. Go ahead and give them a call. Please feel free to ask them any questions you want about the strategy, the Trade Alert service. Go ahead, dial them up. They're a great team. They're there to answer your questions. And most importantly, make sure that you are set up to begin receiving these ETA Trade Alerts as soon as possibly tomorrow. As I mentioned, we're continuing to spot some great opportunities. This market is continuing to print new winners and present new opportunities day after day. So as we continue to spot these brand new setups, we're going to be sending out trade alerts to our ETA members as these setups come across our screen. Now, before I go ahead and conclude my weekly market update, a couple things that I'm watching throughout the rest of the week. Obviously, the geopolitical situation, is rapidly evolving. It's an evolving situation, so certainly warrants some attention. Just kind of keep your pulse on the situation, to see if there's different things unfolding that may be significant to the markets. Certainly have to be watching that. There are also several major earnings reports still left to go for this week. One that comes to mind is Costco that I'm going to be watching very closely here in the next couple days. Also, too, on Friday, we have a major economic report. We have these jobs report from February. This is the non-farm payrolls report coming up in February. Obviously, this is going to be a major market moving event as well. As the market has recently dialed back expectations of the number of interest rate cuts they are anticipating in 2026, of course, the data from this jobs report is going to be massively significant for the Fed, their upcoming meetings, and their upcoming rate decisions. So we're going to be watching that very closely to see what that's going to mean for equities, for interest rates here in the months to come. I hope you really enjoyed this weekly market update. I really appreciate you tuning in to watch this video. Hope you have a great rest of your week. I'll be putting this together next week. Certainly will likely be a lot to break down between now and then, so I'll be looking forward to putting that together for you next week. But again, thank you so much for tuning in. Take care, and I'll see you back here soon.